The 2026 franchise pivot. Services over sandwiches. My name is Keith. I'm a franchise consultant, worked with many different brands, and I put together a list of things that I think you should be aware of and look out for in this year, 2026. If you're looking to buy into an existing, maybe independent business or franchise business, or open up a location or become a partner of a franchise system. Let's get into it. The strategy, why 2026 is different. So we need to move beyond food, I think, largely, unless that's just really the industry you know or you want to be involved with for whatever reason, because it used to define the almost entire industry of franchising, right? People think of McDonald's and brands like that. But in 2026, with labor costs averaging 30% of gross revenue for restaurants, and that's about double the national average. And also with about 89% of restaurant owners reporting that labor pressures are really cutting into their margins. So you're going to have high overhead because of some of the requirements of location. Then you're going to have low margins. And then you also deal with something with food, which is perishable. And so there's so many things that are pushing investors away from that industry and moving them towards leaner models and more efficient models. So the next thing to consider is the alignment rule. Modern franchising is being treated as a scalable asset class. So investors are moving away from buying a job and more towards portfolio franchising, where the goal is a diversified set of brands under one management umbrella to maximize market share per household. All right. And that's a really cool concept. You could do that across different industries or have it more niched to a certain sector. But think about it. You could scale up eventually to own the car cleaning location in your town or zip code, home service of painting, whatnot, the gym, other things which are actually not even brick and mortar franchises like accounting services and things like that, or fundraising services. There's a lot of really amazing and very highly profitable concepts out there that are vetted, that are required under law to report correct earnings. So it's not just some, internet hype thing of, hey, invest in this business or be an Amazon drop shipper or something like that. And it's really phenomenal. So but you can own that for a territory, your zip code or what have you, however it's defined, and have really a diversified asset class. It's really, really cool stuff. Now, scalability. Look for executive models if you want to have scalability. Now, if you just want to replace, quit your job and open up something that is going to be your new job that you own. Obviously, scalability isn't something you necessarily need to look at that time, but I recommend, word to the wise, down the road when you want to step back, it's great to have a business that is scalable, that at least you can step back and out of it and it can still be performing. And that's, to me, part of the value of investing into a franchise system. Or if you get ambitious or want to be ambitious, open multiple locations, et cetera, et cetera. But if you want to do the larger, more expansive structure of really growing that asset, look for executive models. So in 2026, the trend is towards more multi-brand local clusters. And so that goes into the diversified of markets that I was talking about earlier. So by managing a vertical, like let's say home services, you have painting, roofing, and pest control. Owners can share a single tech-enabled call center, marketing team, management team, and that's going to drive down your costs dramatically. And for instance, with even customer acquisition, that alone of having it all clustered together with call center, marketing team, et cetera, can drop your cost per acquisition by about 25%. Put aside brand recognition and things like that of a franchise. All right, so a lot of good upside to that. Then going to the next section, number 2. So top service-based models for 2026. So my first thing on my list is home service and repair. So the U.S. home service franchise market is projected to reach about $39.5 billion by 2032, with a compound annual growth rate of 6.77% starting in 2026. So because homeowners are choosing to repair over replace due to high interest rates, and segments like appliance repair have seen a 15% spike in demand in just the last 12 months. Then the next one is essential and boring businesses. Waste management and commercial cleaning are 2026's real recession-proof winners. So no matter what the economy does, waste management, cleaning, things like that, that's stuff that has to get done. And People are going to pay to have that done, and there's really no other option. So they're almost like essential services. The commercial cleaning market alone has expanded to 451 billion. So offering recurring revenue through long-term service contracts, and then obviously that provides predictable cash flow, which is a great cushion again to have during the increases and the falls of the economy. Then going on to the next one is specialized fitness and wellness. So the big box gym is out. Biohacking is in. While traditional gyms face really thin margins of 10 to 15%, there's some brands that I'm not going to name by name that have built their whole model off of $10 memberships. And now people who are cutting back because they appeal to a certain market segment, they're now utilizing the equipment more and more. And now the equipment's breaking more and more. And so they're having more equipment costs, and it's eating even more into that 10 to 15% margin. It's a nightmare. But with boutique Pilates and recovery studios, they're posting earnings of 25 to 40% margins. Specialized services like IV hydration and cryotherapy are seeing unit growth of 180 to 250% annually because they cater to high net worth people who are health conscious, and we have an aging population. It's a win-win-win. Now, moving on to the next section, the financing reality. So getting into opening a business, buying a business, SBA versus doing it your own, and different ways that you can do this. All right. So securing capital in 2026 requires a preferred status, SBA 7A loans. This remains the primary vehicle for franchise entry. In 2026, viable rates currently range from 10% to 13.5%. So here's a pro tip. Large loans over $350,000 often carry lower interest rate spreads, capped at about 3% above prime rate, than smaller microloans, incentivizing multi-unit or higher asset plays. So again, when you're kind of thinking which way to go, do you want to just do one territory, or do you want to do a couple, or do you want to do a couple in one territory, a couple different model or different concepts? Then equity requirements expect to bring about 10% to 20% cash injection to the table. However, the SBA is waiving guarantee fees on loans under $950,000 for certain services and manufacturing sectors in the fiscal year 2026, which can save you thousands in closing costs. Every penny is important. So let's look at the entry comparison, which path to choose. So you have the entry method, and then you have the new franchise, startup from scratch, buying an existing business. So over the first 5 years, a new franchise has an 85 to 92% success rate. That's pretty good. Then for a startup from scratch in their first 5 years, it's about 35 to 45%. So it's about half. All right. That's you starting your own business from scratch. Then buying into an existing business, that's where you start to creep closer towards a franchise. But again, think about it, that's just a new franchise. So think about buying an existing franchise. That's also a win-win as well. But buying existing business is about 70% to 80% success rate over the first 5 years. Now, a challenge with that is there's a lot of variability there that I'll go into maybe a little bit later in this video. 2026 profit margin potential. So with a new franchise, it's high, 15 to 30% or more in the service-based industry. Startup from scratch, it's really variable, but you do have no royalties. So I have seen people go the startup route because they don't have royalties to consider with a franchise concept. But again, the numbers make sense. There's a reason why that number is there, and that is factored into your margins as a franchise concept. All right. Now, buying an existing business, you do get immediate cash flow, assuming that the existing business is not built off of the owner or, let's say, the manager, and let's say you lose those people and you lose the whole business. That's always something very important to watch out for. But obviously with a franchise system, which has validated success over multi owners and locations and everything else and a proven track record, you are hedging your bets by going down that path. A little bit more dangerous, in my opinion, with buying an existing business, even though you do get immediate cash flow. Loan accessibility. With a new franchise, that is the highest for loan accessibility because of what I just stated, the proven success over multiple markets. It's the highest. Brands on the SBA registry get faster approval than anybody else. Now, you have startup from scratch. It's the lowest, requires high collateral, 30 to 50%. So if you want to put in $200,000 to open up your business, and invest in inventory and whatnot, marketing, et cetera, et cetera, et cetera, you need to come in with about $100,000. Now, buying an existing business, it is also high. Banks do love the existing tax returns and proven success, similar to with a franchise. But again, there's a reason why franchises are the highest. The franchise edge. See, you're buying a speed to market advantage with the franchise, and that's why everything with the royalties and the franchise fee makes sense. In an economy where customer acquisition costs are skyrocketing, a franchisor's national brand can lower your local lead cost by 20 to 30%. I've seen this personally compared to an independent startup, right? Just that brand recognition alone can be worth the investment. The silver tsunami. The 2026 is a peak year for buying existing non-franchise businesses as baby boomers retire, and these are often traded at 3x to 4x EBITDA, making them excellent targets for SBA loan acquisition. Now, again, like I mentioned earlier, the challenge is what type of business is it? That's where you have to really have some knowledge of the industry, or at least have someone that you trust that has knowledge of the industry to evaluate the value proposition. Okay, because I've seen a few people make this mistake. They have a business that's been built, it's been around for years, but it works because they're in it, or it works because they oversee the manager. And once the owner and the manager leave, there are not the systems and processes and the proven success rate like you have with the franchise. With that, and the whole thing implodes. And so you are stuck with just the assets truly of the business, and you paid 3 to 4x the profit for it. And oftentimes it doesn't work out. The 2026 filter. So here's the quick evaluation. Inventory check. Prioritize asset-light models. 2026 investors are flocking to concepts with sub 150,000 all-in costs to avoid the debt trap. Labor efficiencies. Choosing franchises that use AI-enhanced scheduling to keep staff leaner and really use automation anywhere are the ones to look for, and those are the best models for 2026. With staff, you're looking for a 1 to 10 ratio of staff to customer, or even better. Then tech integration. Ensure franchises use generative engine optimization, GEO, to show up in AI searches like ChatGPT and Perplexity, which is driving about 300% growth in online visibility for top tier brands. If you want to look further into maybe buying a franchise system, buying into it, and scaling up with that investment model, then click on the link below. I have a quick form to fill out, and I'll send you some models that I have found that are some of the best and have the best proven track record.